Welcome back to the Daily Crypto Deep Dive. Today we're stepping back from the noise, stepping back from the hourly candles and the quick takes, and asking a much bigger question. Bitcoin is hovering just under $68,000. It keeps pushing towards $70,000 and failing. Ethereum can't build sustained momentum. Solana has just confirmed a bull trap. BNB is compressing inside what looks like a bearish continuation structure. A major European bank has disclosed $100 million in Bitcoin ETF exposure, but with protective hedges layered on top. And one of the most respected institutional analysts in traditional finance has just warned that Bitcoin could drop toward $50,000 before it finds real footing again. So where are we? Is this just consolidation before the next expansion? Or are we entering a longer, slower phase that defines the foreseeable future? Let's start with the analyst call that has quietly shifted the tone of the conversation. Jeff Kendrick, head of digital assets research at Standard Chartered, recently revised his outlook. He suggested Bitcoin could fall to $50,000 before recovering and reduced his year-end target from $150,000 to $100,000. That's still bullish on paper, but the psychology changed. When a global bank strategist publicly lowers targets, it signals caution inside institutional circles. These aren't Twitter influencers chasing engagement. These are allocation desks managing risk across portfolios that span currencies, equities, commodities, bonds, and now digital assets. When they soften expectations, that shift matters. But here's what's important. Kendrick did not call for structural collapse. He didn't say the thesis is broken. He didn't say crypto is finished. He said retracement before recovery. That implies something different from doom. It implies reset. It implies that the market may need to shake out excess positioning before building again. That is not the same as cycle termination. Now look at the tape. Bitcoin is compressing between roughly $66,000 and $70,000. Each attempt to reclaim 70,000 stalls. Buyers push. Supply absorbs. Volume fades. The move retraces. That is not panic. That is hesitation. And hesitation in markets is often more dangerous than fear, because it creates drift. Drift leads to boredom. Boredom leads to overtrading. Overtrading leads to losses. We're not seeing aggressive capitulation. We're not seeing violent breakdown candles. But we're also not seeing decisive breakout strength. This is compression. And compression builds energy. The question is direction. Now let's layer in the on-chain voices. Several analysts have pointed to elevated open interest relative to realized volatility. Funding rates have swung negative. The Fear and Greed Index has dipped into extreme fear territory. Lark Davis highlighted that sentiment levels have hit zones historically associated with local bottoms. Negative funding means traders are paying to be short. When the crowd leans too hard in one direction, markets often snap the other way. That's how short squeezes are born. So we have this fascinating divergence. Institutional macro strategists warning of deeper retracement. Sentiment analysts arguing that fear is already stretched and positioning could unwind upward. These aren't contradictions. They're timeframes colliding. Macro looks at liquidity cycles and central bank posture. Sentiment looks at crowd psychology and leverage imbalance. Both can be right at different horizons. And then we have regulation quietly evolving in the background. The U.S. Treasury is pushing Congress toward clearer crypto legislation this spring. SEC leadership has signaled a more structured, disclosure-based approach compared to previous enforcement-heavy rhetoric. Wall Street CEOs are appearing at crypto forums alongside regulators. The narrative has shifted from existential threat to integration framework. That's a fundamental change. A few years ago, the market feared bans and crackdowns. Today, the conversation is about standards and reporting. That's maturation. But maturity does not equal explosive upside. It equals stability with constraints. It equals slower capital rotation. It equals compliance-driven flows rather than euphoric speculation. Now look at institutional behavior. Intesa Sanpaolo, one of Europe's largest banks, disclosed roughly $100 million in Bitcoin ETF holdings. That is real allocation. That is not retail hype. That is balance sheet exposure. But they simultaneously disclosed put option exposure tied to strategy stock. effectively hedging their crypto-linked risk. That is a sophisticated structure. Long exposure through regulated ETFs, downside protection through derivatives, participation. Without blind conviction, institutions are entering. But they are not reckless. They are measured. They are hedged. They are disciplined. That shifts market behavior. It reduces manic spikes but increases structural absorption. It also means that upside may require more sustained catalysts than in prior retail-driven cycles. Now pivot to alts. Solana recently broke above resistance in the high 80s, attracted breakout buyers, and then reversed sharply lower. That's a classic bull trap. Liquidity above resistance was harvested. Late longs were caught. Momentum stalled. When leading altcoins print bull traps during broader compression phases, it often signals fragility. BNB is compressing inside a bearish pennant after a downside impulse. That pattern statistically resolves in the direction of the previous move unless invalidated with strong volume. These aren't catastrophic signals, but they are not aggressive strength signals either. Ethereum remains steady but not dominant. XRP is stable but not accelerating. Cardano and Dogecoin are consolidating. This is not alt season energy. This is range-bound patience. So what phase are we actually in? This increasingly looks like a mid-cycle consolidation under macro pressure, rather than a late-cycle euphoric top. Late-cycle tops are typically loud. They are vertical. They are emotional. They are accompanied by parabolic acceleration and media frenzy. We haven't seen that kind of blow-off recently. We've seen strong rallies, yes, but not manic climax conditions comparable to prior historical peaks. Instead, we're seeing integration, regulation dialogue, institutional hedging, ETF flow fluctuations, and macro sensitivity. Bitcoin continues to behave like a high beta liquidity instrument. When real yields rise, crypto tightens. When liquidity loosens, crypto breathes. That relationship hasn't broken. So is this it for the foreseeable future? If by it we mean explosive, non-stop upside, then probably yes, for now. Markets need catalysts. ETF inflows have slowed. Liquidity isn't surging. Macro remains mixed. That combination rarely produces immediate breakouts. But it also rarely produces systemic collapse without a trigger. The real risk here is not sudden destruction. It's prolonged chop. And chop is brutal. Chop drains conviction. Chop punishes leverage. Chop forces discipline. It tests whether you actually have a thesis or just momentum addiction. For Bitcoin to drop to 50,000, several structural breaks would need to occur. 66,000 support would need to fail convincingly. 60,000 psychological support would need to crack. ETF outflows would need to accelerate. Macro conditions would likely need to tighten further. That's possible. It's not absurd. But it requires confirmation, not assumption. At the same time, for Bitcoin to reclaim 70,000 and expand higher, it needs sustained volume acceptance above resistance. Not just wicks, not just intraday spikes. Acceptance. That means real capital willing to hold above that level. Until one of those scenarios confirms, the foreseeable future looks like compression punctuated by volatility bursts. That doesn't sound exciting, but it's realistic. Now here's the bigger lens. Is the thesis broken? Institutional adoption continues. Banks are buying ETF exposure. Regulators are drafting frameworks rather than banning participation. Wall Street is showing up at crypto forums. None of that resembles 2018 post-ICO collapse energy. That resembles system absorption. Absorption phases are slower. They feel boring. They feel frustrating. But they are how assets transition from speculative novelty to structured allocation class. And structured allocation classes move differently. They grind. They respect macro flows. They respond to yields. They integrate derivatives. They mature. So what we're likely witnessing right now is not the end. It's recalibration. A liquidity and conviction reset. A period where aggressive expectations meet disciplined capital. Could we dip lower before moving higher? Yes. Could we short squeeze violently from extreme fear levels? Also yes. Could we chop sideways for weeks while everyone grows impatient? Absolutely. But extinction? Collapse of thesis? Structural abandonment? No evidence of that right now. What we have is tension. Institutional caution layered over long-term integration. Retail sentiment swinging between fear and hope. Technical compression building pressure. And pressure always resolves. As always, none of this is financial advice. Crypto remains volatile. Structures can break. Analysts can be wrong. Macro shifts fast. Position sizing matters more than prediction. Drop your thoughts in the comments, smash like, follow, and we will see you at the top.